Hey guys, Felipe here. As you know, I'm here to keep you up to date with current market news and teachings. So in this video, I'm basically going to be talking about the biggest mortgage lender in you can say the world, but specifically the US, right, which is Fannie Mae. Fannie Mae is basically uh, an over-the-counter OTC stock, or at least their common shares, right? Because they trade under $5 a share. Um, it's approximately now like $1.80 per share, but over-the-counter stocks are typically penny stocks, right? Which tend to be extremely risky, right? But I've been watching this company for quite a while now, and a lot of things have been very interesting to me. And specifically, the interest here is a potential release from conservatorship in the future, right? So Fannie Mae and Freddie Mac, but in this case, I'm just talking about Fannie Mae, right? They've been held in conservatorship since September 6, 2008, after the financial crisis, right? Or the mortgage crisis, right? So they've been held under conservatorship with the Federal Housing Finance Agency, which is acting as the conservator since September 6, 2008. As conservator, the FHFA basically succeeded to all rights, titles, powers, and privilege of the company and of any shareholders, officers, or directors to the company with respect to the companies and its assets, right? The conservator has since provided for the exercise of certain functions and authorities by the board of directors. Directors owe their fiduciary duties and care and loyalty to the conservator, which is FHFA. Thus, while they are in conservatorship, the board has no fiduciary duties to the company or its shareholders. They don't have any advisement or any date in that they say they're going to release the company from conservatorship, or if they are, or if the company is even going to exist after conservatorship. But they do have metrics that they set in place, such as goals for Fannie Mae to meet basically certain performance goals, which in a way they seem to point towards a potential future exit of conservatorship, and they have basically paid Treasury more than all the money they used to bail them out during that crisis, right? So they are Fannie Mae and Freddie Mac. In this case, I'm just talking about Fannie Mae. It's become, or it is, a cash cow currently for Treasury, right? Because they make a lot of money. So some of the things I've come across from their financial statements and so forth that I find super interesting. And if you kind of want to see the state of the US housing market, their statements are, beautiful to kind of give you an idea of what the US housing market is doing. So one thing they always note is basically growth of household formation stimulates home building, right? Home building has typically been a cyclical leader, weakening prior to a slowdown in US economic activity and accelerating prior to recovery, which contributes to the growth of US gross domestic product, right, and employment. So home builders or leading economic indicators, meaning, for example, during a recession, they tend to get hit first in terms of some of those companies' stocks start to decline and so forth. And ahead of a potential economic recovery, they seem to perform ahead of everything else, right? So their home building is basically a leading economic indicator. So how housing activity can affect Fannie Mae's financial results. Basically, housing is among the most interest rate sensitive sector in the economy. In addition to interest rate, two key aspects of economic activity that can impact supply and demand for housing, and thus business and financial results, are the rates of household formations and housing construction, right? Which has been pretty low, right? The housing supply has been an issue over the last couple of years. Net revenues basically have been relatively flat. So basically, fair value gains in the third quarter of 2023 were primarily due to an increase in interest rate during the period. The increase in net income was partially offset by an increase in other expenses, net primarily due to 491 million of expense attributable to a jury verdict and an award of prejudgment interest for Fannie Mae's preferred stocks shareholders in two cases consolidated for a trial in the U.S. District Court of for the District of Columbia. So I find that interesting because that means that shareholders have begun, in a sense, winning cases against the conservator, right? Which is FHA, FHFA, Treasury, and the government, pretty much. One thing they note is basically stress in the banking sector, particularly for regional banks with significant exposure to commercial real estate, could further tightening bank credit conditions, dampening consumer and business confidence, and lead to reduced consumer spending, business investment, and hiring activity, right? Because if banks tighten their credit, that means there's less loans going on, less money being borrowed, less expansion going on, right? Because we live in a credit economy, basically, right? All these companies are constantly taking loans to expand and so forth. So if credit tightens, that means that there's less access to funds. How interest rates can affect basically the housing market, and in this case, Fannie Mae's financial results. So net interest in a rising interest rate environment, Fannie Mae loans generally prepay more slowly as borrowers are less likely to refinance. That's actually good for mortgage lenders. In this case, Fannie Mae, they amortize various cost basis adjustments over the life of a mortgage loan, including those related to certain upfront fees that they receive at the time they acquire single-family homes. As a result, prepayment of the loans result in accelerated realization of those upfront fees as income. Therefore, as loan prepayments slow, the accelerated realization of amortization income also slows. Conversely, in a declining interest rate environment, mortgage loans generally prepay faster as borrowers are more likely to refinance, typically resulting in the opposite trends of higher amortization income from cost basis adjustments on mortgage loans. Interest rates also affect the amount of interest income mortgage companies, in this case Fannie Mae, earns on their assets, right? Other investment portfolios and retained mortgage portfolios typically earn more interest income in a higher interest rate environment and less interest income in the lower interest rate environment, right? Which depends on the size of their portfolios, right? And can impact the amount of interest income that Fannie Mae in this case can recognize during a certain period. So high interest has been benefiting them because they've been generating more interest income, right? So in terms of their fair value gains, they have exposure to fair value gains and losses resulting from the change in interest rates, primarily through their mortgage commitment derivatives and risk management derivatives, which is typically interest rate derivatives or hedging and so forth, which they mark to market through earnings, right? Fair value gains and losses on their mortgage commitment derivatives fluctuate depending on how interest rates and price moves a bit between the time a commitment is open and when it settles, because it's basically derivatives, right? The net position and composition across the yield curve of their risk management derivatives changes over time. As a result, interest rate changes increase or decrease, and yield curve changes parallel, steepening or flattening shift will generate various amounts of fair value gains or losses in a given period for their derivatives, right? Benefit provisions for credit losses when single family and multi-family mortgage interest rates increase. They expect credit losses on loans increases because, one, they generally expect fewer borrowers will refinance their loans, thereby extending the expected life of the loan, which increases their expectation of loss. And two, borrowers with adjustable rate loans or multifamily loans with balloon balances due at maturity face increased costs and reduced ability to refinance. This increases their expectation of loss, contributes to their provision for credit losses, right? Conversely, when single family and multifamily mortgage interest rates decrease, their expectation of loss decreases, which reduces their provision for credit losses. So that's some interesting stuff that I've come across their financials, right? That kind of tells you a little bit or teaches you a little bit of how the mortgage market works, right? And I find that super interesting. So I'm just going to swap here, and I want to talk about Treasury and some of the restrictions while they have been in conservatorship, right? Because my interest here is the potential future release from conservatorship, which this would, in that case, go from a penny stock to, pretty massive move in terms of stock price, right? So dividend restrictions related to conservatorship. Their conservatorship was announced in September 7, 2008, that they would not pay any dividend on the common stock or any series of preferred stock other than the senior preferred stock. So they only pay dividend for senior preferred stock, not for common stock, right? And then the director of the FHFA has directed us to make dividend payments on the senior preferred stock on a quarterly basis for every dividend period for which dividends are payable. Restrictions under senior preferred stock purchase agreement and senior preferred stock. The preferred stock agreement prohibits us from declaring or paying any dividend on Fannie Mae equity securities other than senior preferred stock without prior written consent of Treasury. In addition, the provision of senior preferred stock provide for dividends each quarter through and including the capital reserve end date and the amount in and if any by which our net worth as of the end of the immediate preceding fiscal quarter exceed an applicable capital reserve amount, which they have, right? They've been meeting both their capital reserve amounts and their leverage buffers, right? Which means the company is healthy financially. And from what I've researched, they have more than paid Treasury back their money, right? Plus they're meeting a lot of the financial goals that Treasury and the FHFA as a conservator has placed on them, right? So Fannie Mae's one hell of a company right now in terms of financial health, and it's a cash cow for Treasury, right? So the applicable credit reserve amount is the amount of adjusted total capital necessary for us to meet the capital requirements and buffers set forth in the enterprise regulatory capital framework. After the capital reserve end date, the amount of quarterly dividends to Treasury will equal to the lesser of any quarterly increase in our net worth and a 10% annual rate on the then current liquidation preference of the senior preferred stock. Payment of dividends on our common stock is also subject to the prior payment of dividends on our preferred stock and our senior preferred stock. Payments of dividends on all outstanding preferred stock other than senior preferred stock is also subject to prior payments of dividend on the senior preferred stock. Statutory restrictions under the GSE Act. FHFA has authority to prohibit capital distribution, including payments of dividends, if we fail to meet our capital requirements. The director of FHFA, however, may permit us to repurchase shares if the repurchase is made in connection with issuance of additional shares or obligations in at least an equivalent amount and will reduce our financial obligations or otherwise improve our financial condition. While currently applicable, our payment of dividends will be subject to the following restrictions under the enterprise regulatory capital framework effective on the date of termination of our conservatorship. So I'm just speculating on this, but it seems like there's a probability of final future release of conservatorship for Fannie Mae, and in that case, that would be Freddie Mac as well, right? Due to they continuously have been meeting the financial goals set to them by the FHFA and Treasury, right? And they have more than met the financial obligations in terms of the bailout that they received during the 2008 financial crisis. The maximum payout ratio for a given quarter is the lowest of the payout ratio determined by our capital conservation buffer and our leverage buffer. We will not be permitted to make any distributions during a quarter if our eligible retained income is negative and either our capital conservation buffer is less than our stress capital buffer or our leverage buffer is less than our prescribed leverage buffer amount. In terms of their balance sheet, like I said, Fannie Mae is the cash cow. They have been producing a lot of revenue, and their net income has been, trending up, right? So net revenues, and this is in billions, right? Basically, we're looking for their annual 2023 financial statement, right? Is 21 billion. That's 21 trillion 250 billion dollars. There's a ton of money. Net income is let me see here, is I would say that's 13 trillion 465 billion dollars. That's a ton of money. That's a big freaking number. Scroll here, the cash and cash equivalent and securities purchased under the agreement to resell. That looks good. Total assets have increased. Pretty much they have a lot of assets. Total liability has not increased a lot compared to the last year, which that's good to see. And equity continues to go up, right? That is what 73 trillion 725 billion dollars of equity. That's a lot of equity, right? Their net income has increased in comparison to 2022 year to date, right? So for 2023, their net income increased by $2 billion basically. So that's good to see. What else we got here? Here, just basically interest rates, which are all currently high, right? You have the 30-year FRM rate, 10-year Treasury note rate, 30-year Fannie Mae mortgage-backed security coupon rate, and secured overnight financing rate, right? Which is basically one of the rates that banks lend to each other internationally, right? So all these rates are currently up. And in terms of the mortgage rates, in terms of interest income benefits, Fannie Mae, right? Because they earn interest on those rates, right? So you can kind of see here, all of these rates are pretty high, at least for the year 2023, right? They have somewhat changed during 2024. So new housing starts. Here we have multifamily starts and single family starts. So Fannie Mae specifically just lends in residential real estate, right? Which is multifamily homes and single family homes, right? So there has been a lack of supply, meaning for the fact that why housing prices have remained high, right? Because if there's lack of supply, housing prices are going to remain high, or possibly continue to go higher, right? But here we're seeing a decline of new housing starts, right? So new housings starts negative 23.5%. So that for specifically multifamily, right? So it has been down quite a bit. So you can kind of see that there. This is super cool. I kind of like how they kind of break everything down. It's pretty cool. If you, like I said, if you want to see the state of the real estate market in the US, Fannie Mae, Freddie Mac's filings are beautiful in the way they basically, you know, they share what current market conditions are or for that period in their finances, right? So benchmark interest rates are all high, as we all know, right? They have all basically trended up. 30-year FRM rate, 10-year Treasury note, 30-year Fannie Mae mortgage-backed security rate. They're all up, right? Pretty high for the recent past, pretty much. Here they kind of share which states have been seeing increases in housing prices and which states have not. The ones in red have basically either seen decline in housing prices for, in this case, the year 2023, whereas the darker green has basically housing prices have increased during that period, right? So this is some super cool stats here that you can kind of get an idea of what the housing market is looking like for that period, right? In this case, we're looking at the period of 2023, according to Fannie Mae, basically. So let me just leave you guys with some history here, which I find that interesting because everyone knows that the regional banking sector is not healthy, right? In terms of basically they're holding on to a lot of paper losses on commercial real estate loans, right? Which what I like about Fannie Mae is that they're not in the commercial real estate market. They're in the residential market, which is single family homes and multifamily homes, right? But in 2023, we did see, you know, kind of a spark of a panic in the banking sector with the fall of Silicon Bank, right? And some other banks along those lines too. But of course, Federal Reserve stepped in and injected a lot of money into the banking sector, which might have potentially been one of the reasons for the big rallies in 2023, right? So I find this interesting in terms of history, right? Because it's kind of eerie the way that things always seem to occur again in a similar way, right? So during 1929 to 1930, under such circumstances, any runs on banks for whatever reason became to some extent self-justifying, whether the quality of the assets held by banks had to dump their assets on the market, which inevitably forced a decline in the market value of those assets and hence of the remaining assets they held. The impairments in the market value of those assets held by banks, particularly in their bond portfolio, which is kind of like what we're seeing now, right? Interesting, was the most important source of impairment of capital lending to bank suspensions rather than the default of specific loans or of specific bond issues. From the middle of 1931 to the middle of 1932, railroad bonds lost nearly 36% of their value, public utility bonds 27%, industrial bonds 22%, foreign bonds 45%, and even United States government securities 10%. Commenting on bank suspensions in 1932, Bray Hammond wrote, "The situation had worked to the point where the stronger banks were being dragged down by the weaker banks, partly because the latter drew on the former for reserves, and partly because forced liquidation on portfolios by banks and difficulties impaired the value of portfolios of other banks." Makes a lot of sense to me. And possibly why the Federal Reserve keeps injecting a lot of capital into all these banks that seems to suddenly go into trouble, such as we recently saw with New York Community Bank, and how they have pretty much injected billions of dollars into it, right? Similarly to 2023, when there was somewhat of a bank panic in the early part of the year, Federal Reserve steps in, injects a bunch of money into the banks. What are these banks going to do in return? They're just going to buy up assets, right? And pump up all these assets to basically stay out of trouble. So I find that super interesting. It's very similar to in the past. And I'm just curious how long or how much longer the Federal Reserve can keep pumping these banks, right? So with that being said, thank you guys for listening. If I share something valuable with you, feel free to like and subscribe, and I'll talk to you guys in the next one. Have a good one.